In this video, we will see what makes a great investment. We will take a look at this article and we will review it together. Good business, great stock. And it will take the example of Autozone. So Autozone, I know the company quite well. This is my second largest position. In case you don't know the business, they will explain how the company operates and how it has been a beautiful investment if you had invested in this company a couple of years ago. And I still believe that the company is a great compounder for the long term. So we will review this article and I will comment on it, and it will be a lot of fun and you will learn a lot. It will be filled with value. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing in great companies, including the investment in Autozone. I've been investing in Autozone since 2024 now, a little bit more than 1 year now, and it has already generated me a lot of capital. So I'm enjoying the company and I know it's a great bet on the future. So let me start with this article from Jan Cassel. If you don't know Jan Cassel, he is the founder of Micro Cap Club, and this is a good hunting ground for small companies, small caps, micro caps. Okay, good stock, good business, great stock. If you find a well-run, cash-generating micro or small cap, share this article with the management team. Subject, just do this. Okay, so let me zoom in a little bit so you see better. Okay, this is a table that we have for Autozone, right? This is Autozone, ticker symbol AZO. It's publicly listed in the US. You can check it out online. These are the fundamentals of the business. In 1999, 2009 and 2019, and now the latest report, the annual report, is trailing 12 months 2024 for revenue, net income, outstanding shares, earnings per share, share price, and PE ratio. Okay, these are the main metrics that are important for Autozone, and you will see something very strange that very few companies can do. In 1999, the company had $4 billion in revenue. And in 2024, they had $18 billion. So that's a 300% change. That's a CAGR of 6%. If you only look at this change, CAGR of 6%, yeah, everybody can do it. It's normal. Nothing that is really shiny. And it is also why this business is performing so well in the stock market. The basis of operations for Autozone are stable. The operations are stable or growing a little bit. You don't have a lot of cyclicality. You don't have a decaying business. You have a steadily growing business. I'm saying this is quite important because that's the foundational base we have to build this beautiful capital allocation policy. So now if you compare the revenue to the net income in 1999 we had $200 million, and now you have $2 billion or roughly $3 billion. That's a CAGR of 10%, compound annual growth rate of 10%. The difference you see between the revenue growth rate of 6% and the net income growth rate of 6%, of 10%, is due to the efficiency. They have better margins. So you can improve your gross margins, you can improve your operating margins, you can play around with some numbers, distribution centers, efficiency, cost effectiveness. That shows you, only these two metrics show you that the business has become more efficient for the past 20 years, 25 years, okay? Going from 6% to 10% is a lot. And now let's talk about maybe the most important metric for Autozone, right? The outstanding shares. In 1999, the company had 150 million shares outstanding, and now it's 17 million. So they have bought back 90% of their shares over the past 25 years. And if you combine this huge buyback program to the net income growth of 10%, you have the earnings per share that has gone up from $1 per share to $150 per share. So that's an increase of 20% per share. Only the buyback policy, coupled with a net income growth of 10%, gave you an earnings per share growth of 20% per year for 25 years. This is the investing grail you can wish for, and this is exactly why Autozone is a great investment. And guess what? The share price has been going up by 20% per year on average for the past 25 years. What you can see is that in the long term, stock prices follow earnings per share. If you manage to find a company that can grow its earnings per share by 15% per year, 20% per year, it's very likely that in the very long term, the stock price will grow by 15% per year or 20% per year. Autozone is a great example, and you can check other companies like this. The Walmarts of the world, the Berkshire Hathaway of the world, many companies in the very long term follow earnings per share. So not only earnings, I'm saying earnings per share, because this is important for Autozone. You can see that that's the PE ratio in 1999, and the PE ratio in 2024, it was 15 or 20. So most of the earnings growth, most of the stock price growth comes from earnings per share growth. There is no valuation that is going very expensive at the moment. You don't have a lot of multiple expansion, as we say. The business has never been excessively expensive. All the stock gains are due to the earnings per share growth. Now let me continue and start this article. In 1988, Eddie Lampert launched his fund ESL Investments. Legendary investor Richard Rainwater invested $28 million in seed capital. The first 10 years was most traditional stock picking, and he built up a good track record. Lampert's investors were prominent individuals like Michael Dell, David Geffen, Ziff family, and the Teach family. Maybe you know some of them. Eddie Lampert is quite famous actually. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. By the late 1990s, he became more activist in his approach, pushing management to make changes. By 2007, his fund ballooned to $20 billion in assets after racking up 18 years, averaging 30% annual returns. This is a quick introduction. Don't worry, we will talk about Autozone later. A few years prior, he placed big bets on AutoNation and Autozone, which were 25 plus positions in his fund. Big bets. So you have a company in auto parts and a car dealership. Both are share cannibals, as we say it. So both companies, AutoNation and Autozone, are companies that are buying back their shares intensively. I know both companies quite well because I've been investing in Autozone for a few years and recently sold at a profit, and I'm still holding Autozone. So I know both companies. Beautiful buyback allocator. In 2003, Lampert invested $700 million buying Kmart debt at 20 cents on the dollar and provided the bankruptcy reorg financing. The debt was converted into equity. Lampert owned 50% of Kmart equity. He was in control. Lampert had the Midas touch. Kmart lost $3 billion in 2002. Post-bankruptcy, Lampert financing Kmart was able to produce $400 million in operating profit in 2003 and $900 million in 2004. Also in 2004, Lampert sold 70 Kmart stocks, so that's 5% of the base, for $900 million to Sears and Home Depot. Maybe you know Sears, I'm sure you know Home Depot. And Kmart stock soared 300%. The sale gave him the idea that Sears was also an opportunity. And over several months, he negotiated Kmart's purchase of Sears for $12 billion. This is activism investing, which retail investors can't do. But this is quite important to have a sense of how all the operations of all these companies are operating. are doing. If you have a big investor owning the majority of a company, you can expect big moves. And if you are a brilliant capital allocator like this investor, you can make a huge gain in the stock market. I'm not doing some activism, but I know some people that are doing some activism on companies. It's very hard, but when you are successful, you make a lot of money. So including this one. Eddie was at his peak. He was on one heck of a run. He looked like he could do no wrong. And then you will see what happens. In a 2018 Vanity Fair article, Richard Rainwater said on Lampert, he's so obsessed with moving in one direction, he wants to move that sometimes people get burned, trampled on, bumped into. I think he has gone about alienating himself from almost everyone who is come into contact with. Yeah, not the kind of people you want to eat together on Christmas, I guess. Another former colleague said, he's really an extreme guy. There is something odd about him. I think his lack of emotional connection to people, it's so important, but some people just don't have that. They're off in their own little world. This is also the reason why he's been so extremely profitable and successful in his career, because he's so numbers oriented without much emotional sense. And that is also, quick tip for you on a side note on this video, a lot of investors are not really emotional. And there is a beautiful book that I have here called Richer, Wiser, Happier from William Green, talking about the greatest minds of investing we've had over a couple of decades. And Charlie Munger read this book, Richer, Wiser, Happier. And the first thing he said was how many of these big investors are divorced and very bad when it comes to a happy marriage. So it's very hard to be emotionally strong and successful in investing. And a lot of big investors have difficulty connecting to other people emotionally. So that is not a massive red flag from an investing perspective. It's, I would say, normal in the investing community to have this kind of behavior. It's just that Eddie Lampert was a little bit extreme to that sense. Okay. That was the end of the side note. By the way, if you like this kind of content, you can leave a like to this video. When you are on a winning streak, you want to bet heavier on the next bet because you feel you've earned the right. Sears would become 70% of Lampert's portfolio in 2007. The position totaled $16 billion. 10 years later, its value declined by 90%, 95%. It's been a horrible investment, and this is also the reason why not a lot of people talk about Eddie Lampert right now in 2025, because his prime was a couple of years ago. Sears filed for bankruptcy in 2018, and Eddie Lampert still owns the 9 remaining Sears stores scattered around the country. Most investors remember Eddie Lampert from his one major stumble and forget about some of his amazing successes. And now we will talk about Autozone. Let's dive into Autozone. Autozone, O'Reilly Automotive, and Advanced Auto Parts make up 40% of the retail automotive replacement parts market in the US. These are boring businesses in major industries, but the compounding lies below the surface. In the US, the average age of a car continues to rise. It's true, in the past you had an age for a car of 7 years. And now 8 years, and after that 10 years, and now I believe it's more than 13 years. So you have an aging fleet of cars in the US, and these cars need repair, and this is where these 3 companies operate. As a car ages, the maintenance costs go up. It costs $2,000 per year to maintain a car with 50,000 miles, and it costs $4,000 per year to maintain a car with 100k miles. Autozone, O'Reilly, and Advanced Auto Parts are similar, but the differences are in the nuances. Historically, Advanced Auto Parts caters to the "will do it for you" consumer, while Autozone and O'Reilly cater to the do-it-yourself consumer. Advanced Auto Parts has been struggling lately. Yeah, you can check on the internet. The ticker symbol is AAP. Oh, here you go, here. And the stock has been declining. And you know what? I will do it for you. The stock has been declining. The capital allocation decisions have not been great. So we will see. We will see. Look at the stock price. Like, it's been horrible for shareholders lately. And now the stock is maybe coming back to life because of a great earnings report lately in May. And the stock is up year to date. Flat, yeah. But historically speaking, it's not been a great investment. Let me continue. Advanced Auto Parts has been struggling lately and the stock chart tells the tale. But in general, all three are very good retail businesses with great margins, 55%, and high returns on capital. In fact, the title of this article isn't completely accurate. Autozone isn't a good business. It's a low growth, great business. If you remember correctly, if I scroll up, you have a revenue growth of 6%. Here you go. So it's a good business with high margins, but low growth. Okay. I'm saying this again because it's the foundation for everything. Let me continue. Autozone's intense focus on the customer was born in the 80s and 90s. Autozone stores were deliberately designed to be light and inviting instead of a dusty, dark, and gloomy store. In the 80s, they were the first retailer to private label parts and give a lifetime warranty, even when the manufacturer themselves wouldn't provide one. They were the first to offer an electronic catalog in all stores that would allow employees to look up parts, warranties, and check inventories at nearby stores. So yeah, you have a little bit of innovations, but this is a slow moving business. In the 90s, they were the first ones to use satellite technology to connect their stores to their warehouses to increase efficiency. Pretty ingenious. Most importantly, AutoZone employees grew a reputation for always going the extra mile for the customer. Quite important. If you know anything about marketing and efficiency when it comes to businesses, you will see that this aspect of investing, having this culture of going the extra mile, is key when it comes to customer retention. Amazon is obviously doing it. So you want 10 out of 10 customer service because happy customers will come back. And now you have AutoZone and O'Reilly that are very similar. You want clients to come to AutoZone and stay to AutoZone. So you want your clients, your customers to be happy to work with you. And this culture of going the extra mile definitely helped AutoZone. 40% of the market outside these major chains is mom and pop mechanics and small auto parts retailers. So the industry has always been ripe for consolidation. In the early mid-90s, AutoZone acquired a 500 store chain and a 200 store chain and was spending considerable money on refitting the stores. This caught the attention of Eddie Lampert.
By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
Here we go. In 1998, Eddie Lampert started acquiring shares of AutoZone. He ultimately acquired 30% of the company and joined the board 1 year after this, in 1999. Lampert helped refocus AutoZone away from big acquisitions toward big buybacks and focusing on capital efficiency. At the time, the stock price from AutoZone was this. Let me show you. At the time, in 1999, you had a stock price. Maybe you can't see very well. Let me show you this. Okay, let me go back in time on a monthly basis. In 1998, this was your stock price for AutoZone. So this was a company that was growing very fast and doing big acquisitions. And then Eddie Lampert took a big position in 1999 around here and things turned. So you could have bought the stock at the same time and the stock price was $30. $30. And now the stock grew and grew and grew. And now you have a stock price that is at, let me remove my face, $3,000 $700. So it's been a great ride for investors that held over time. Each Autozone store cost $2 million to build out, produced $2 million in annual revenue at 20% operating profit. If you include debt and capitalized leases, it's close to 40% ROIC. By the way, even right now with the scale, Autozone is still having a 40% ROIC on its stores. That tells you a lot about culture, efficiency, and runway. To Lampert, what made sense was slow, methodical growth, like 200 stores each year, and plowing all excess cash flow, all the cash flow, into buybacks. This deliberate approach didn't just enhance shareholder value, it reshaped AutoZone's identity as a company that prioritized creating value over chasing scale. I've read all the annual reports of AutoZone for the past 25 years. So I know a little bit about AutoZone. And if you look at the annual reports at the time, 1998, 1999, there was no mention of buybacks. A little bit here and there, but no big deal. And then everything turned in 2001. In 2001, the company started implementing a big buyback program, and they continued. And over the next 20 years, the company has had this culture of maximizing value per share, revenue per share, earnings per share, free cash flow per share. So they continue to think on a per share basis, which is key, and so few businesses do it actually right now. So over 20 years, if you think on a per share basis, you plan to improve your free cash flow per share, earnings per share. And if you increase your earnings per share by 20% per year for 25 years, look at what it does for your stock price. This is very good news in terms of culture. This company has been shareholder oriented since a while now. Eddie Lampert stayed out of the board until 2006 and sold out of his position in 2012. Making 20x on his investment. He would have made 100x if he held on for another 12 years. Investing is hard, even when it's easy. This is one other takeaway for you guys watching this video. Sometimes you find a beautiful investment and you sell too early, and this cost of omission is huge, I would say. Most of the time, when you are finding yourself in the lucky position of owning an AutoZone, an O'Reilly, an Amazon, a company that you really believe in with a strong culture and a strong efficiency, with a long runway, hold on for dear life. Let me continue. Even though AutoZone has been a 20-year 100-bagger success story, the stock has never been expensive, historically trading between 13 and 20 PE, price-earnings ratio. With a low revenue growth of 6% CAGR, compound annual growth rate, 6% growth rate, the company amplified its earnings per share growth to over 20% annually. If you do some simple math, the buybacks turn a 10% internal rate of return, IRR, into a 20% IRR. As we've seen in the table, the net income has grown by 10% per year, but it was boosted by the buybacks. So the earnings per share, so net income per share, has grown 20% per year. It turned a good outcome into a great one. So this table shows you exactly what you want to look for if you want to find the next AutoZone. Maybe AutoZone can continue to grow at 20% per year. Maybe there are other companies that fit this criteria. I personally know a couple of companies that are following the same path with good potential in the future. It's all about efficiency. O'Reilly's growth rate is double that of AutoZone, which has historically given the equity a higher valuation between a PE ratio of 20 and 30. Yeah, O'Reilly is a similar company, roughly the same size, and the growth rate for revenue has been bigger. So the company O'Reilly has struggled more during 2008, but the rebound has been great. And this is a company focused on growth a little bit better, I would say. So the same thing, they are doing buybacks, they are very efficient, very good margins, but the growth is better. So the PE ratio is not around 15 or 20, it's about 20 or 30. So better growth, better organic growth, better valuation, higher valuation. What is interesting is the earnings per share growth rate is quite similar between the two companies. Yes, you have a better growth for O'Reilly, but you have more buybacks for Autozone. Both stocks have performed extraordinarily well. If you look at O'Reilly, you have a revenue that has grown 13% per year for 25 years. So that's more than Autozone. You have a net income that has grown 17% per year for the past 25 years. Just this is a very good fit. Not a lot of companies can grow at this kind of rate for 25 years. And they did some buybacks over the years, which bring the earnings per share growth at 20% per year. And look at the stock price, roughly the same. You have a stock price that has gone up by 24% per year for 25 years. As you say, you only need one. If you know how to spot these kind of opportunities, you can generate 20 or 24% per year. And you have a PE ratio that has not gone up massively over the past 25 years. In 2000, you had a PE ratio of 25 for O'Reilly, and now recently you have roughly 30. So not a lot of change when it comes to valuation. All the stock price gains were due to the earnings per share. For cash generative microcap companies, the message is clear. Success isn't about becoming the biggest or growing the fastest. It's about finding the right size for your business model, industry, and management team. This principle applies not only to the size of the business, but also to its shares outstanding. Disciplined share buybacks can provide an invaluable mechanism for creating value when orchestrated in a thoughtful, disciplined manner. This is why it's so important to think on a per-share basis. Microcaps should adopt Autozone's mindset, focus on operational efficiency, use buybacks strategically to compound earnings per share growth when reinvestment opportunities are limited, avoid the temptation to chase growth for growth's sake, especially through acquisitions fueled with debt and with the leverage. You can make a lot of acquisitions and dilute your shareholders. This is the kind of things you want to avoid, especially through acquisitions that strain resources or exceed integration capacity. We live in a revenue growth at all costs type of world. Investors, investment bankers, analysts, they all scream at management teams to grow faster. This is especially true now that we live in an AI world. You want to be the leader, you want to grow the fastest. It takes incredible discipline to turn your back on the crowd and instead focus on earnings per share growth at all costs. If you find a well-run cash-generative microcap, share this article with the management team. Subject, just do this. This is incredibly important, and a lot of people are looking after the next golden opportunities with the most amount of growth for the revenue. It takes a lot of discipline from management teams to say no to this growth, to only grow at 6% per year, and to only focus on earnings per share, efficiency, buybacks. There are some tools to find these golden opportunities, to find these companies that can grow earnings per share at 20% per year. If you want me to help you find these tools, use these tools, as always, you have the first link in the description with the coaching program. You can book a call with me. You can prove to them there is another way, to the management teams. A slower growth business can still be a great stock. And I will add something else to this analysis. Something else that Monish Pabrai has said in an interview. Not all companies can be compounders with buybacks, Uber cannibals, as we say it. Not all companies can be cannibals. You have to be a business that is either stable or growing. If you are a decaying business and your revenue is going down and still you use all the cash flows to do buybacks, you will destroy shareholder value. You can also use debt to fuel the buybacks. You can use, I would say it, leverage buybacks. You have some financial engineering to boost your earnings per share over the very long term, but it is not the goal of this video. This video is here to help you understand the power of buybacks. And I believe if you focus on finding the next Autozone, small company that can compound for the very long term, you can have great returns.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.